a little bit of context today. Obviously, we're in an environment where the ATO has been very active. They were very passive during COVID, as were banks. And I guess we're all in the business of lending to small business, one way or another. And I know that many of you in the leasing business sort of thrived during COVID, but I've got to tell you, in the cash flow business, in our business, we were head-to-head competitors with the ATO and head-to-head competitors with banks that weren't really that keen. But the ATO is gearing up. And so we've got some wonderful panellists here that are going to talk to us about what the ATO is up to and how to have conversations with your clients that help them in dealing with the ATO, but also help you in raising capital for them to help them grow through whatever headaches the ATO may be presenting. Of course, the ATO itself is not the problem. The ATO is the symptom. The underlying problem is that maybe the business has suffered during COVID. We're still seeing a few of those. There's interest rates, all sorts of pressures that small business are under, and that manifests itself as an ATO situation. So I'll just quickly go through who we've got. We've got Michael Moon up the end here from Tax Assure. Michael was born a lawyer, but he's now an expert ATO negotiator. How long's Tax Assure been going?
We're now 11th year.
11th year. So we've done a lot of work with Tax Assure. Shannon Kavanagh, who is an accountant with Bacchus, and I guess a lot of accountants like say, "Oh, none of my clients have tax issues." But are you an elitist like that, Shannon?
No, some of mine do.
Some of them do. Okay,
or it's a new client.
Right,
Well, that's
right.
Yeah.
Not too proud to admit having a couple of clients that have tax issues. And Sule Anordovic, how many of your from what's the name of your firm now?
Sally Advisory.
Sally Advisory.
Yeah.
One of the juggernauts in corporate restructuring in Sydney and Australia. You have a few clients with ATO issues.
Almost every one of them.
Yeah. So obviously Sule is an administrator, a liquidator, and we like to sort of see him doing some informal restructuring work. Would see some of those. So we're going to go around the panel asking a few questions, and as I say, I guess at any point, if you feel like if you've got a good question, we're bribing you to be interactive. So just before we kick off, can I just see a show of hands? In the last month, have you had a deal where there's been ATO arrears that's maybe giving you a bit of a headache? Just put your hand up. Yeah. So we've seen a few. What about the last 6 months? Yeah. Okay. All right. So there is an issue there. All right. We're going to start with Michael. Michael, the ATO has been stepping up since COVID. Yep. What is the ATO's approach? What are the tools that they've been bringing in? What are some of the key stats? I mean, is it 15 billion, 50 billion, 100 billion in small business? So what are they doing, and what are some of the stats, and what are some of the things that small businesses are suddenly finding themselves dealing with?
Yeah, look, Nick, and thanks everyone for coming today and for giving your time. I know everybody's busy. Look, as we mentioned, we've been doing this for over 10 years. This is the toughest I've seen the ATO in that time. We all know what happened during COVID. They essentially said to businesses, don't worry about the debt you have, and also keep lodging, but don't worry about paying the debt that you're accruing doing this. And, it's a little bit of a deja vu from the GFC. And so what that has meant is that I think in terms of the numbers, which kind of sort of explain where we're at. If you look at, and these are just the published numbers from the ATO, prior to COVID, 30 June 2019, it was $26.2 billion in undisputed tax debt. The latest published figures from last year at 50. So that's an 89% increase in a 4-year period. We think it's higher than that because a lot of the businesses we are seeing have got a lot of unlodged debt. So I've heard 60 billion, potentially even $70 billion in debt. And I think, one of the things, if there's nothing else to take away from today, and I'll explain a little bit more about why, but the debts are not only, there's a lot more taxpayers, but the size of the debts are increasing. In the past, we've been able to work with businesses and get their debts out through cash flow. A lot of businesses can't do that at the moment. So the people in this room are part of the solution for that. And I think, that's a market that needs funding. In terms of what the ATO are doing, credit reporting is a big one. Who's seen a client recently that's been reported to the credit reporting bureaus? Yeah, they've done 30,000 of those this financial year so far. DPNs, again, who's had a director that's had a DPN? And I'm sure everybody knows what I'm talking about. I don't need to explain.
Maybe just give the nutshell, the one.
Credit reporting is...
Well, the DPN, sorry.
Yeah, direct penalty notice. Basically, if you're a director of a company, you set up a corporate structure so that you sit behind it and you're not personally liable. It doesn't work with tax if you have unpaid GST, pay-as-you-go withholding or superannuation. When you don't pay it, you become personally liable. People think it's the notice that makes you liable. That's just a precondition for the ATO actually suing on it. But, what you find is that if you've got those debts, the ATO issuing these like confetti, there was 20,000 of these issued already this year, and they issued a bunch. That was their initial thing. And what the ATO say they do it is to get directors to engage. But what it does mean is if you're a director, and there's two types, and I won't go too much into the detail, there's a lockdown one and a non-lockdown one. The non-lockdown one allows the director to go and see Sule or one of his colleagues and put the company under within 21 days, and they avoid the personal liability. But if you're a business owner, and it's also 21 days from the day of the letter, you might not see it for a week or so, and you've got 14 days to decide whether you want to either put your house on the line, because a lot of people aren't structured in that way, or put your business under. It's tough. It puts a lot of pressure on directors.
Just one little take out there is if you take nothing else away from what Michael just said, is if you're talking to someone, they have got arrears. One good question is, have you received a director's penalty notice?
Yeah.
Because then at least you understand the scale of the problem that you're dealing with. Because if they have received a director penalty notice, if they're no longer able to hide behind the corporate veil, as you know, that a limited liability company allows them to do, they're all of a sudden they are in the
I think on that too, Nick. The other thing is, if you haven't received a director penalty notice, there'll probably be one coming. So the only way to avoid getting one of these, people often say, what can we do to stop it? You've got to get into an active payment plan with the ATO. The ATO, for all of these things, the thing that stops it is what they call active engagement. And people used to think that was, I'm talking to the ATO, I'm paying money, and I had a client just yesterday, exactly that, doing all of that. And they've got a credit reporting and a direct penalty notice is on its way. So it doesn't stop it.
And just finally, before I sort of move on to Shannon, this number of 30 billion, 50 billion, whatever it is, I sat down there, with a calculator or pen and paper and crossing out zeros to try and work out what the average must be. It must be really high.
Yeah.
Like we're not talking about 100,000. Some of these debts are I've personally seen 5 million, 6 million.
Yeah,
so
yeah, look, it's interesting because that's the thing, as I mentioned before, about the size of the debt. And look, I don't have the stats on what the average is, and I'm not even sure they're available. But what I do know is our client base hasn't changed much over the last 5 years. The average debt we are seeing has almost doubled. Our average debt, we do everything from people with 100K to, I've got a guy I'm dealing with at the moment with 8.5 million. But our average debt, because 2/3 of that debt is small business, by the way, it's not top end of town. So that's the 30 billion, is the small business component. But our average debt was around that sort of $500,000, $400,000 to $500,000. Our average debt's now around about 900, but we're seeing regularly, Zelly and I spoke to one last night, 1.7 million. That's not a small debt for us at the moment. They're big numbers.
I have a question.
Yeah. Just say your name when you.
Rowan, sorry.
Yeah, and where you're from.
John Nickley. If you're seeing those sort of statistics and you've got a bulge of people coming off fixed interest rates into variable interest rates, which is going to squeeze them further, and 2/3 of that is small business, is there any modelling you've seen as to where the maximum squeeze is, or is there any statistics on that?
What do we ask?
I haven't seen any modelling for it, but there has to be. Essentially, what's happening now is a catch-up of 4 years. People haven't amortised down their debt. The ATO has woken up in 2024, the back end of 2023, really, and has got a massive receivables ledger, and it's going to collect it. The money has been spent largely on personal assets. We're seeing Division 7A director loan accounts as a massive problem. They've taken the money, poured it into personal assets or lifestyle. Those assets, yes, have gone up in value, which is quite beneficial, but they've created not just a DPN, but a personal liability because of deemed dividends that will flow from those loan accounts. So I'm not sure in hindsight if they should have been so lenient to taxpayers that were in arrears, say from 2019 and before. My personal view, the benefit of hindsight is they probably should have enforced on the ones that were in trouble before COVID started. More sympathetic with the ones in COVID, but it's just a catch-up moment. There used to be 10, 11,000 corporate failures a year on average, and it's looking like it's going to be double or triple that.
Yeah, I don't think if it was 10,000 a year, they haven't gone away. It's just that now I say that the insolvencies from 2020 are now in 2024. But I don't think I personally think, to answer your question, I don't know what the stat is, but I think there's a two-sector economy. Because when you pick up the papers, everything seems to be reasonably rosy. But I think small businesses are under the pump a little bit. So Shannon, you've obviously got a lot of small business clients. Who are trying to raise money. So what are some of the other indicators that you're seeing that maybe let's say what are the other ways that this tax arrears is affecting their businesses?
Well, I suppose cash flow straight away. That's the big thing, and they've come out of the honeymoon period that we've talked about. It's pretty hard on them as well. You think during COVID, some industries will hit particularly hard, but the tax office said, look, don't worry about it, and actually we'll give you money. Now, logic says, okay, the honeymoon is going to end, but I still think that's that sort of switching over now. Actually, we do have to pay it, but perhaps maybe as Sule said, maybe the ATO were a little bit too lenient because they gave a lot of rope now, and now so hang on, I've kind of got this sort of this massive debt which I know I need to repay it, but at the same time, we need a bit of a hand. But also then I think, and this is where I suppose the broking and the different types of finance that are available. I've got an $800,000 debt now that needs to be repaid in 2 years. So if I use a sort of case study, I've got a good example of a client, and they ended up with let's say $1 million tax. So when you're talking about the average, so trying to get finance initially, they go, it's obviously a red flag, but if you actually did the analysis, well, let's have a look at their whole debt profile over that period. Now, what they did, let's say their total debt was about $3 million between the bank and the ATO and trading liabilities. At the end of COVID, the whole debt profile was still $3 million, but the bank debt had gone down by $1 million. So I've got a better bank over here that doesn't want any money back and will probably remit an interest. So I'm paying that down. But the problem is now I've got this debt that needs to be serviced over or repaid over 2 years, and I need to do something. Plus, it's a massive red flag in trying to get finance. So looking at I think the sort of the original question, but how do you evaluate? It's really looking at what has happened over you've got to have a bit more holistic sort of picture.
Well, let me ask you. You would have clients, and they've got some sort of an issue, and you might have to try. The broker might approach you to try and give them something to go back to the bank or the lender with. What is some of the ammo that you as an accountant are able to provide a broker that, obviously tax arrears is a problem, certainly it's not a problem for us. As I said, we're calling this a 30 billion refinance opportunity without wanting to appear mercenary about it. But
I don't think it is mercenary, though, mate. I think it's actually solving a problem.
Yeah, no,
sure.
Yeah, no, as I say,
Yeah.
But as I say, it is a problem for someone who's maybe talking to one of the major banks or even and so what ammo are you able to provide for them when they're dealing with the lender?
Yeah, I think it is trying to put that whole story together. And again, it's probably a good example, and particularly in that SME space where a lot of people have started their businesses, they borrowed based on their house. So I use this example, and this company ended up with $10 million worth of equipment. It's high-tech stuff, financed using 5-year leases, but with equipment that lasts 10 or 15 years. So, their debt got up to about sort of 7 or 8 million, but they paid it down very quickly. But the loans kept ending. So it was hard to refinance based on what equipment you've got, what assets you've got. But then I suppose just generally being able to put a picture together that goes a little bit beyond 1 or 2 years. Let's have a look at 15 years of this, and let's have a look at the asset positions going like that. The debt's gone up like that and back down, and then let's analyse that debt profile as well. As I said, you've got trading liabilities, you've got tax debt, and you've got bank debt. Now, how can we sort of put this together? And probably even looking at that suite of finance as well. And again, SMEs aren't that sophisticated I don't think accountants are that sophisticated in the different types of finance either. But being able to understand, it's not just going to the bank and borrowing on your house. It's looking at your different options, and then you look at your blended rate as well. Because I think a lot of my clients, they might say, okay, well, invoice financing might be 12% or whatever it is, and they go, oh, that's too expensive. But actually, let's analyse your blended rate. You've got some good assets here, and we can borrow it at X%, and let's start looking at it a little bit more holistically. Use all those assets too. I mean, you think about these guys have gone and bought their house. They've got a $2 million house. They've also got $2 million worth of receivables as well. So just as sort of valuable and things like that. So I think it's trying to get that overall picture and being able to tell that bigger story. And we've got the data there now too. I think
it's interesting. I always say, and by the way, I've got two of my key staff here. I've got Zach Bowman. Zach, who say hi to Zach. Well, Zach and I were talking yesterday about this very thing. We're sort of whiteboarding the graphs about the life. The life of the equipment is. A JVC is still worth something after 10 years. The initial finance is fully amortized over 5 years. So there's certainly a well to be able to go back to raise working capital. But the other thing is, I always say, I've got lots of little pithy sayings. I'm 60 this year, and I'm full of wisdom. And one of the things that I say is there's two kinds of accountants. There's the accountant that, and I'm sure a lot of people have encountered this. They don't want to give advice to their client. They're frightened about giving advice. They just want to do the tax. I call them compliance accountants. And it's very hard when you're dealing with a compliance accountant who looks at the headline rate of our finance, for example, and is it expensive? I mean, I say to an accountant, well, why doesn't your client just use a bookkeeper for the Philippines? Because you're expensive. And then all of a sudden they realise, well, hang on, no, I add a lot of value. Well, so does the right money in the right way. And then there's the other kind of accountant, I sometimes call the entrepreneurial accountant. And when you're talking to them, sometimes you get confused because they talk about their client as we, and you go, we, do you own part of the business? And no, it's just that's how. Has anyone had that experience? You know, we're doing this and we're doing that, and you go, I didn't realise he must be on the board or something. But he's got that relationship. That he understands, or she understands, that that it's the capital, the more expensive capital, is a means of getting from A to B, and they can make money out of it, save the business, go beyond just the house as security. Yeah, I don't want to put words in your mouth, but
Yeah. No, that's exactly what's happening.
yeah. All right, Stille. Well, I guess you're where the rubber hits the road with a lot of this stuff.
I'd like to supplement what Michael said about what you guys as brokers should be inquiring about in respect to someone's tax, because it's really important to understand whether it is just a company debt or whether there are tails into the director's personal exposure, because you really got to understand it. I'm going to try and keep it simple and not get technical. But the first question is the obvious one: have you got a director penalty notice, and has it expired? The second one, really, the question is this: have you been lodging your tax, and that includes super and BAS, within 3 months of when it should have been paid? So it's a really important question, because that's, without getting into what lockdown DPNs, what that means is if they haven't been lodging within 3 months of when they should have been paid, they become automatically personally liable for it. And there won't be a notice, there won't be a letter. It may be a year or 2 years down the track where they'll enact the mechanism and issue a lockdown DPN, and there's nothing you can do about it. So 2 easy questions: have you got a DPN? Has it expired? 2, have you been lodging on time within 3 months of when you should have paid the debt? So March quarter, have you lodged within 3 months of the end of April? By July, if you haven't lodged, you're liable for that quarter. That puts a whole different spin when your client comes to you and is asking for money. He's got a $500,000 debt. If he hasn't lodged his stuff on time, in principle, he's personally liable for the whole lot. Yeah, so it's just really important. Finance works really well around what we do. It is obviously, at first blush, you're not going to get any money because there's administrators and restructuring people involved. But I just did a plumbing company in Tweed Heads 2 months ago that was trying to get money to pay its debt, hadn't paid anything for about 3 or 4 years. Fortuitously, had lodged some of it on time, some of it not on time. There was a statutory demand issued, a winding up application filed, and I got appointed 3 days before the hearing. We managed to adjourn the wind up, trade the little plumbing business on, get a proposal from the director, obtain finance against her assets, stay the winding up, implement a DOCA, draw down the funds post DOCA, pay out the ATO 30 cents. Not the best scenario because they didn't leave us enough time before the wind-up hearing, but it is possible. And another scenario is a transport business owes $4.5 million to a main bank. Big four banks are notorious for, one, not understanding what happens in this world, but two, not liking it. So we had a sort of, there were a lot of debtors receivables in this particular matter. We had a cash flow lender take out Westpac in this case, fund the administration, trade on, enter into DOCA. And the real problem was $10 to $50 million of tax through this transport group. Compromise it down to under 20 cents in the dollar and move on. So yes, big banking institutions with cheap rates don't like this, but there are lots of people like Hermes and others who understand the process, who get comfortable with the asset security, allow the restructure to happen, allow the appropriate compromise to happen, rebirth the business with the training wheels. And then as that problem is gone, there is no more tax problem, there is no wind-up applications, a refinance will occur to a major bank. Yep.
Can I ask Soleil, sometimes one of my other colleagues, Catherine Moore, is here up the end there. Sometimes we get a deal on our desk and I say to Catherine, Catherine says, why is this deal, why has the broker put this deal on our desk? She, being the general manager, she has always looking for ulterior motives. And I think that often, the one thing is obviously that the broker wants to help, as Michael says, and wants to earn a commission and all the rest of it. But I think in the back of their mind, also, one of their concerns is, obviously they want to help the client, but the client is one client. In many ways, their real client might be Westpac or Macquarie Bank. The last thing they want is a loss. They don't want an L in their column with respect to Macquarie Bank or Westpac or wherever it might be. So in these scenarios where you are restructuring, okay, I understand the ATO may have lost a limb, but the leasing companies are still in one piece.
Yeah. The corporate restructuring tools, be it a small business restructuring or administration or any other insolvency, in prima facie don't compromise personal debts. So personal guarantees, uncompromised. It's very rare that a finance company will release a guarantee. I have had certain situations, but it's extremely rare. What you're really looking for corporate restructuring to work in a formal sense is unsecured debt. At a high level threshold, most restructuring mechanisms require that employees are paid. most restructuring mechanisms require secured debt to either be continued, refinanced, and or paid. The real value for corporate restructuring is around unsecured debt, and that could include obviously ATO and trade and supply creditors. One of the biggest holdups in that space, over the last sort of decade or so, is how trade suppliers have morphed to include guarantees, and how businesses have become really reliant on their suppliers because of those guarantees. And it's hard to offer a trade supplier is critical to your business 20 cents in the dollar when they hold basically keys to your house. So the ATO is the brunt of most of these compromises, unfortunately. Yeah.
What I'm going to do is I'm going to circulate to everybody everyone's contact details here. And one question that I won't ask you now, but other people may have, is something, because obviously we're thinking about when their client is suffering these problems, but of course there's other times when their customers are suffering these problems, and they're worried about, you've got someone who is a supplier, your client is a supplier, and you're worried about what it means. You might get an alert that their customer has got an ATO issue, and then they're worried. There's a whole raft of issues that we won't go into right now, but they're welcome to get in touch with you. Sure. But what I am just, again, I'm thinking from a finance brokers, and most of our brokers are equipment finance focused. But just the point is that the bank is staying whole on their equipment, and how cooperative are they if there is a restructure? How likely are they to leave their equipment in place?
Just strictly speaking, on equipment finance, extremely sympathetic. In fact, they're directed. So in a lot of cases, we'll get appointed in whatever capacity, and we'll assess the equity in any particular equipment. Let's just say it's a truck, and the truck is worth $50,000, but the payout figure is $60,000. If it's some part of a business restructure going forward, we'll continue to make the payments and return the truck back to the company for them to continue. But let's look at a sort of worst case scenario. 60,000 payout, 50 value, there's no equity. We on behalf of the company would disclaim the contract with the company, and the lease company, whoever they might be, is actually obliged to go to the guarantor, which is usually the director, to see if they'll take on the lease payments of that truck. It's just a formal obligation. If they don't want to take on the lease payments, of course, you get into the territory of them taking possession, selling the asset, and then calling on the shortfall from the guarantee.
Okay. Thanks, Sully. Michael, what you obviously, I know often, so I try and get in touch with you. You've got very busy at the moment, obviously doing your ATO negotiations. Without giving us all the secret ingredients of the Colonel's chicken, what are some of the negotiation strategies that work? And I guess in telling us that, just so that brokers can identify, what is a salvageable situation.
Yeah, 100%. Yeah, look, the key is probably two things. Early engagement. The sooner you get in with the ATO, the better outcome you get. If you leave it till there's a statutory demand or you wind up, then it's very difficult to do anything about that. But we still do that, but I guess the outcome we get isn't quite as good. The other thing is you've got to engage with the ATO properly. The ATO have got quite detailed legal practice statements, and this is why we get about 35% of our work from accountants, because we've actually read them. A lot of people haven't read them, they don't really, and they're getting a lot of requests back from the ATO at the moment saying, we want this information. It's been in the legal practice statements forever, but the ATO are now enforcing them strictly because they're wanting to show not only that a business can afford to pay the money back, but they're viable, and that's become a big issue with the ATO at the moment. So we're doing a lot of work around that, but every day we're getting businesses that are somewhere along that recovery space with the ATO, getting them into long-term payment arrangements. We're also working with brokers, and I'll explain a little bit about that if we need to bring finance in. But look, I'll give you an example. We had one just recently, and it was actually brought to us by a broker. There was already funding in place, but they've been reported to the Credit Reporting Bureau. It was a construction company in Western Sydney, $1.4 million debt. They'd had the reporting done, and they'd come up because they were looking to do some more lending. The funder, it had massive consequences because all the alerts went out to both the funders and also to all their suppliers. Suppliers put them on COD straight away. The funder said, we're going to pull your facility, forget about the new lending. We were able to go in, and we did this in about 2.5 weeks. We provided a comfort letter they gave to the funder and to their suppliers. They continued to support the business. We got the minimum payment plan. We got the credit listing removed permanently, and that's one of the things that is a little bit different to the ATO listings. They go off permanently, so you can't do anything about the alerts that go out. But we knocked about 300 grand off the debt, and then they moved on. So that's kind of an example where we can do it. What we're doing with a lot of brokers too is where they are trying to do a deal. And imagine if you're partway through trying to place some funding, probably not with Nick and Hermes, because again, we work with them because they're very comfortable in this space. But a lot of lenders, if one of these things happen, and the big thing that can potentially happen is either they get the credit listing or there's a statutory demand that's issued and it blows the deal out of the water. So what we're doing is that we're working with the brokers and with the ATO and bringing them into the transaction and saying to the ATO, we know you want to get paid. There's an outcome here to get you paid in full, but we need you to not do anything for 3 months, whatever the period is that we need to get the funding through. Then we make sure that it doesn't kill the deal. while we're doing that, we go and clean up the interest and penalties. And that's another thing too. Silo and I were talking about it earlier. He was saying, is that making a difference? And it is, because it's 11 point, it just came down. It's now 11.34% calculated daily. You guys are in the industry, you know how that. We see businesses that, 20, 30. We had one just last week. 70% of the debt was interest. They still did the funding, and what it meant was that they were able to borrow more. They had extra working capital, but that made a massive difference to the cash flow in the business. So there's solutions out there, and there's pretty much always a solution. About 3% of our clients we can't fix, and that's why we would then say, look, we suggest you go and see somebody like Sile. But the rest of them we fix, and there is a solution. But as I mentioned before, the big issue is the numbers are so big now that a lot of businesses can't do it out of cash flow. So there's not only are you part of the solution, it's a massive opportunity for anybody that's looking to do some more business. Go and chase businesses with ATO debt. And if you've got a lender that's uncomfortable, there's plenty of lenders. Well, there's not plenty, but there's a couple of lenders, and Hermes is the one that we work with, because they get it, they understand it, they'll support the transaction through, and they do the deal.
Okay.
I've got a couple of questions here.
Oh, yep.
Gus Gilson, Greg Capital. I'm just interested about the actual ATO's engagement and timeliness on that. We've seen a lot of clients that they just won't respond to it.
Yeah, yeah. Look, they're look, there's no doubt about that. The ATO are flooded at the moment. They also had a bit of an issue because during COVID, a lot of the guys went to Central Link and gave away money rather than collecting it, and a lot of them didn't come back. So they've been everything. But look, it's all about, for us anyway, it's a bit of squeaky wheel. We just keep pushing and pushing and pushing. And, particularly if there's a transaction that's in place and we've got a deadline, we tell the ATO that and we get them to work with us to that deadline.
Okay.
Sorry,
Shannon.
there was just one.
Oh, sorry.
I have two questions.
Yeah.
All good for the line.
Yeah.
Just kidding. One for Michael, more specifically, and the other one for open for our panel who may have a view on this. We all can see from statistics that in terms of winding up issuers and all that, state was racking up their recovery action. Do you see in the past few months an obvious shift in ATO's attitude to negotiate payment arrangement, particularly when there is no legal proceeding on foot? Whether it's just case to case, depends on the company financials and the officer in charge, or whether it's the contrary, they're doing also this recovery action, serving out default notice and DPN, and sort of inviting the taxpayers to come forward, but there will be more open to a long-term payment arrangement.
Yeah, there's 2 points there, and I think you're right on both of them. The first point is, what is the ATO's attitude to payment plans at the moment? And I would also throw in their remissions of interest and penalties. The answer is much tougher. They've actually come out publicly and said their appetite for long-term payment plans has lessened. And so there's no doubt, and that's why we're getting a lot more work from our accounting referrers at the moment, because they're going in, putting in stuff they would normally get through, and the ATO is saying no. Having said that, if the case is put in the right way, we're still getting them through. But it's just, our guys are working a lot harder to do it. But there is definitely, and it's not a secret because the ATO have come out publicly and said that. The second part of your question I've just forgotten was around, the enforcement. Yeah, certainly around the enforcement stuff. Again, the ATO are under pressure, the Commission is under pressure to do two things. Bring that debt level down to 50 billion or whatever the actual number is, and get taxpayers compliant again. On the first part of it, there's two ways they can bring it down. They can either collect it or write it off, and write it off is around and that's basically closing businesses down. But there is no doubt the use of I call them the four horsemen of the apocalypse. The credit reporting, DPNs, garnishee notice, and winding ups has increased substantially, and the stats are showing that. The other thing is, not only they increased, the speed of it is dramatically faster. I used to say to people, going back 3 or 4 years ago, from start to finish, and they didn't even have the first one, so it was only the three of them. You've got about 80 months to 2 years. I had one just before Christmas. In 6 weeks, they went from one to four. So the timing around it, and what the ATO are doing is just going, bang, that doesn't work, bang, that doesn't work, bang, that doesn't work, wind up.
All right. Can I ask?
Sorry, does that answer your question?
Yes, I actually do have
Oh, you had another one.
one
Cool.
more follow-up question that can be open to all panelists. In the past few months, there has been news about ATO chasing very aged debts, old debts. Although they have previously advised taxpayers or that tax agent that's uncommercial to sue. And understandably, there has been concern being raised in the community and calls for ATO or the government to look into pausing that recovery action for debts that's for certain years back. How do you see this being developed, and if any development, how soon do you expect anything to happen, if at all?
Yeah, Shannon.
Yeah, I haven't had any examples of where they have re-raised any debts they'd previously written off. So I haven't seen that yet. So I haven't read it, but I'm not exposed to it at the moment. But I don't know.
I think a lot of the criticism, just quickly on that, was they were re-raising really small debts, and it was a bit like the robo debt issue, and they were concerned about that. But there's no doubt the ATO We see it a lot with people go, oh, the ATO, they're not pursuing that because it's uneconomical to pursue. But the minute you lodge a tax return and show you're making money, they will re-raise it, irrespective of the amount.
Okay, Shannon. To sort of bring it away from where things are too tough with the ATO. One of the things with the finance brokers, particularly if they've got clients they're providing finance to all the time. Sometimes it might be a car or a piece of equipment, whatever it might be. And so the brokers are actually seeing financials quite frequently, and to the point where they're seeing they may be getting in a little bit early before things escalate too much. I mean, what sort of advice do you give clients? When you see when you see the problem early on before it's escalated too badly, but you know how it's going to finish. I mean, what are some of the things that?
Well, I think in the first instance, it is actually having a look at that information. So again, you get into the SME space. I think people start their business. Again, they come out of an employee arrangement. PAYG has been taken care of. Now I'm responsible for remitting tax and lodging and that sort of stuff. But that, particularly when you start, there's a bit of a free ride for a while. You think even with lodgements, I mean, we're just lodging. 25th of May is the deadline for lodging the BAS for the 31 March. Now, transactions that might have happened nearly 5 months ago. So I've been collecting all this GST. People probably don't necessarily have the discipline. And it's like, oh, hang on, 25th of May, now I've got this debt. Where did that come from? So it's just being on top of it. I think understanding, what the timetable is so that, you've got that discipline. But I think now with, technology as well. But I suppose a bit of my background, I came from an insolvency background. Realised I didn't have a thick enough skin to do it, but
you have heart, do you?
No, there's a few. But it was a common thing. You come into and still they might be able to comment. You come into a business that's become insolvent. A common theme was that there was no record keeping. People weren't staying on top of things. So when we sort of started up the business services practice, it's a lot of people they'll do the bookkeeping to get a BAS done, or they'll do it, to get a tax return done. But after the end of the financial period, 2 months after the end of the quarter, you've still got to do the same amount of work. So just have it like you're the financial controller instead. So just staying on top of things, I think, and then being able to know what that timetable, when I've got to pay, and also just being a little bit more proactive, I think, in having a look at it. Because if you look at a balance sheet, there's a line that says GST. So print off the balance sheet at 31 March. Well, that's what I've got to pay in 2 months' time. But what's happening is, you get some information. I will start the bookkeeping in May sometimes because I've got to lodge the BAS, and then I'm surprised by this debt that I've got. So I think it's just trying to have that focus like a financial controller, and that's what external accountants can do. We do, we act as sort of like a part-time CFO, I suppose, for a lot of.
Well, some accountants do. As I was saying before, you've got accountants that just sit there and are happy to just do the compliance. But I guess accountants like Shannon, they do conceive of themselves as the CFO or external CFO who's being preemptive about that stuff. All right, Sule, we're going to ask you the last question before we throw it out to the floor. One of the reasons we like working with Sule is that he does have a bias to saving the business, and also is happy to maybe just say, look, this actually we can avoid insolvency here. All you really need to do is think. But what are some of the things that you look for to see whether or not there is actually a solution outside of insolvency?
I do have an affinity with restructuring companies through deeds of arrangement and SBRs and the like. It's just what's more exciting for starters. The staff want to do it, and much rather than the terminal wind-ups. But in terms of the ingredients, we've touched on a few things. But one of the first questions is really the desire of the directors to get through the pickle they're in, because there's a lot of ostrich heads and sands in some of these moments, and you really need to find someone who's committed to going the distance. The financial position and the tax return position being current is absolutely critical, not just to understand where you're at, but one of the big items the ATO are keen to tick in terms of box ticking is that all returns are lodged and up to date and their debt is properly quantified. So they're like things like continuity of business, employees saving their jobs, but compliance is a big ticker box. So desire, knowing where you're at, your compliance history up to date, then it's just a case of convincing the body of creditors that the cash flow going forward, if you put the brakes on the old debt, looks good, or what other further capital is coming in the forms of capital or cash flow lending or director home lending support and all those sort of things. All you've really got to do in simplicity is convince the body of creditors that the deal is better than shutting down the business. And quite frankly, in most cases, it's not that difficult to establish that, because with employees, they continue their jobs in a liquidation. They have termination and redundancy pay. So avoiding that is in the interest. With landlords, they continue getting paid their rent. They don't have a 2-3 year rental claim. So there's various reasons that financial re-engineering means dockers and SBRs are better than winding up. But the big thing is the desire and willingness of the owners of the business to actually dig in and have a go.
But when is it that you see a business that maybe they think that they need to enter into a formal insolvency, but you look at it and go, actually, you don't need to do that?
The culture of early engagement is pretty poor. Most people aren't really coming to people like myself unless they're in the frying pan. Occasionally, you get a few people who think there's problems coming, and all of a sudden you get the full suite of tools available. You could do a safe harbour type engagement, which is a confidential engagement. You can do informal restructuring. It might just be process people improvement. But in a lot of things I do, they're coming in because they've received some bad news in the form of a legal threat, a DPN, a stat demand. Something's gone wrong, and the runway gets short. In addition to the sort of ingredients I said before, most of these formal restructuring tools require a minimum of about 30 days a month to implement. The other big hurdle is having enough cash liquid resources in that period to just pay the bills to get to the other side. And when I talk about the bills, we're not necessarily talking about fees and legals. We're talking about just wages, insurances, rents, suppliers, and all that sort of stuff. And we've done some stuff with Hermes where we funded through those tricky periods. If you can't step through that month period, doesn't matter what the plan is, you've got to survive. So the other tough discussion I have is trying to convince a director not to spend every last dollar in his bank account before he goes into one of these things, because we just won't be able to pay the bills the very next day. So some tough conversations.
I guess from Hermes' point of view, I like to think that we bring two things to the table, in these situations. One is obviously, we've got 14 years of expertise in asset-based lending into these, what we call special situations. But the other thing is that we've got great networks. We've got people, people like Sule, Shannon, and Michael who, because we can't do it all ourselves, we're just financiers. But a broker comes to us and says, we've got this problem, and we say, well, okay, we think we can structure up a funding package like this, but we think you should talk to Sule about protecting the directors from the creditors while you go through some sort of restructuring, whatever it might be, Michael, to get onto the ATO.
Just following on from the question to Sule around, would they maybe not need a formal appointment? We get quite a lot of referral work from liquidators who have somebody to come into them, and their business is okay, it's just the ATO. So what they'll do is they'll send that to us and say, guys, can you sort the ATO out? In which case, they don't need to go through a formal appointment. If you can't, we say no. You need to go back to Sule, for example, and you have to go down that route. But it's often a good sort of check because, as I mentioned before, certainly 97% of the time we can fix it, and those that we can't, they at least know that the director knows when it's come from the referrer that everyone's had a good look at it before the surgeon operates.
Yeah, I mean that's what Michael and I were talking about at the start of the breakfast. It's a comment, and I did refer a matter to Michael's partner a couple of weeks ago. Because I just asked a simple question: if I had a magic wand and could waive away the interest and penalties, can your business sustain the core debt? Because the commissioner doesn't have the discretion to compromise core debt unless you go through a restructuring informal process. So if I did get rid of the interest and penalties, can you enter in a payment plan? Can you survive? And they thought they did, and that's why we referred them to Tax Assure. But not everyone can. But in principle, you start from the position that you've got to pay your tax, right? We're all taxpayers. We're community people.
Got to pay for those submarines.
What we do is serve for people who can't pay it. Yeah. Yes, there are some people who want to take advantage of the process for their own particular reasons, but the starting position is you should be paying your debts, and if you can't pay your debts, you move on and you suffer along with all other business owners in the country. Yeah.
All right. Well, we do have a $30 billion, maybe whatever the number is, $30 billion refinance opportunity. We want to protect our clients and save our clients when they've got this. We also, hopefully want to save your lenders as well, and make sure that your lenders are staying in one piece. You've got a tax negotiation expert here, one of Sydney's preeminent entrepreneurial accountants, and arguably Australia's preeminent insolvency expert, and of course, asset-based lender, stress situation lender here. Open the floor to some questions. So the question is, are there situations where the company has entered into an administration to seek, obviously, to do a deal with its unsecured creditors so that it can survive and be restructured, But where the ATO is, in most cases, the largest creditor, do you ever get resistance from the ATO in that scenario?
I think the best way to answer it is, what are the boxes you would like to try and tick to get their support of any particular restructuring proposal? I highlighted a few earlier, but continuity of business is a tick. Keeping staff employed is a tick. If they perform any particular special service or a regional service or community critical service, that's a tick. Compliance, as in all your returns up to date, is a tick. Fifth one is an important one. You won't find it in any commentary, but it is prior broken promises. If you get a business where the directors have entered multiple payment plans, have offered plans and have defaulted on them, it's an issue. It's just, yeah. And then the last limb is genuinely being able to give them a greater sense in the dollar than they otherwise would from a winding up. Then demonstrating the capacity of the company, remembering it's gone insolvent in the first place. What is going to change? What are they going to do? Where's the fresh capital coming from? What does the cash flow look like? What have they done differently that's going to change the outcome from last time to deliver the better sense of the dollar? So that's the roadmap. If you can do it through the creditors meeting channels, which is the preferred channels, then you've got better prospects of getting it done. If you have the matter like I described a few moments ago, where there's a winding up application to be heard, things get more challenging. You don't always get the voice of all the creditors at the meeting deciding it. You've got to convince a judge or a registrar or the ATO to abandon the wind-up hearing to go to a creditors meeting to vote on it. And half the reasons why they've ended up a winding up hearing is lack of compliance, broken promises, defaults, da-da-da-da.
I guess that's
The key umbrella question is borrowing the money today and paying out the entirety of the tax debt the preferred course of action, or is introducing that capital as part of a restructuring package a better option for the business, weighing up all sorts of factors like what are the contracts in that company, what is the impact of doing anything formal. Let's go back to Terry's point. If there's a whole stack of interest and penalties in a 1.5, if that can be got rid of, you don't need it. You've got a big number, you've also got big turnover. I don't know what the profit looks like, but it's probably just a discussion with people who know what they're doing in an informal sense and a formal sense, and talking to the right lender and then making a decision.
Can I say, this is going to sound a little bit agricultural, but taking it away from a formal lending scenario. But let's say you've got a business that's in trouble, and Uncle Peter's money bags, and he can put some money into the business. I've got an old saying, sometimes you're better off lending to the business after they've gone broke. And in this case, when we say after they've gone broke, after they've gone through an administration. And the reason for that is, as tough as it is for the ATO and for the unsecured creditors and suppliers, you might be able to add $1 million to that business, but all you're really doing, you're not touching the side. One of the things that we do is we look at okay, well, you've got trade creditors, and what's the 60 and 90, just as a bit of a guide. What's the ATO? Actually, one of our lending criteria is aside from is there enough security, is there going to be enough runway? So are we going to be providing enough money to solve the immediate problem and provide a working capital platform for the business going forward? Now, if the answer for that, if you're looking at it and you go, well, you trade. I know you said you've asked for this information, you may not have received it as yet, but the question is, are we? Again, another one of my sayings is, are we solving the problem or are we becoming the problem? Now, it may well be that if we lend money now, we're just going to become the problem because we've saved the ATO and we've saved the NAB, but there's no way they're going to service our debt and we're going to become the problem. Alternatively, sometimes it might be, well, I can come up with $1 million, but they really need $1.5 million. And look, some of that is ATO. And so we'll ask Michael, listen, if you can renegotiate the ATO debt, I don't need to find the money for that. Or maybe I only need to find the money for a down payment. And so we can take that renegotiated $500,000 plus the $1 million I can come up with and solve the problem. Other times it might be, look, we can find how we can see how we can maybe take out the bank because they're not going to support the deal going forward. Maybe we can see how we can provide working capital after the business has been restructured, but we can't sort of find how we provide enough money in the short term to provide enough runway to solve all the immediate problems. And that's when it is, look, maybe this thing needs to be restructured, and we can help on the other side or help through the process, make sure the wages are being paid through that restructuring process. I don't know. Does that answer you?
Probably if I can add one thing, because we wear a slightly different hat in that circumstance, I'd say let us have a look at it. Because what we'll do is all those questions you haven't asked. The whole purpose of this isn't to make everybody a tax debt negotiator and know all those things. We ask all those questions. So what we would do in that situation is, just a simple introduction. We don't charge to have a chat and review their position, and we review their position with them, with the ATO, and we find out all the things. And one of the things we can find out is, have direct penalty notices been issued? What are the next steps with the ATO? Are they on the precipice, or have they got plenty of runway? And then you may be able to bring some funding into your deal. And they may need to go down that route, but they may not need to go down that route. As Nick says, there might be $500,000 in interest there. That changes the whole thing dramatically with many businesses. But it's not even just that. If they're at the right place with the ATO will support businesses. They don't want to wind them up, and they don't want them to wind themselves up. They will support them. So it'd be just a question of just having a look at that and then assessing. People often say, good debt and bad debt. With the ATO, there's bad debt and really bad debt, and it's finding out where they are on that spectrum. If they're down this end, almost always fixable.
Do you speak to their accountant as well?
Yeah, we have to. We work hand in hand with the accountant because we need information from them.
I think that's that collaborative thing too. I mean, if you ask the question, at what stage should I get these guys in? I think if you've got all the information, it's easily digestible. I don't think Michael or Sule or Nick, you're always happy to have a look at it. And I think that collaborative approach as well. I think, again, from, say, an accountant's point of view, or probably a broker, we just think there's one solution, and it's just having that awareness that there are, like you say, well, if I can get rid of $500,000 worth of interest and then, maybe we can lend, or why throw good money after bad paying the tax office when we can just, either do a docker and get rid of some debt and we've got, a smoother road ahead. So I think the awareness and then that collaboration, but also having good information too, which makes it easy, and that's the approach.
I would say, kind of half related to that question. I will say, for a broker that is able to help a client through one of those situations, assuming it's a genuine situation, you have got a client for life. I will say that much.
I think it's important. It's important to understand what's legal, what's illegal, and if you don't know what you're doing, don't go anywhere near it. The core ingredient of a legal Phoenix is an asset valuation, a goodwill business valuation, a good lawyer, a sale contract, consideration paid at proper value, commercial terms, with the old entity going into some form of insolvency, with that liquidator having possible rights and claims as against the new company and the directors for their conduct, and that's why it needs to be done so well.
Is there a difference?
There is a difference depending where you are in the country, actually, amazingly. The comparison of most businesses in New South Wales, say, versus Western Australia, they're a huge difference, and it's all around structuring. It appears, generally speaking, on the east coast of Australia, companies and corporates have been better structured in terms of business. Asset holding companies, service payroll companies, and other sort of SPVs. You find in WA generally, and I'm sure there are corporate structuring specialists there, a lot of businesses where trading operations, employing operations, contract operations, asset holding are all in the one entity. So in a lot of restructuring in WA, it's extremely different from that in New South Wales. The issues that are catching people out across the country are the aggression of the ATO in terms of their notices. If you are the recipient of one of these documents, you don't have a lot of time to do anything about it except pay it, enter into a payment plan, which means you'll be personally liable if you default on the payment plan under a DPN. So what you're really saying is you've got 3 weeks, maybe 2 weeks, subject to mail, where you've got to make a decision where you're guaranteeing the debt or you're going to do something. There's little time to start planning anything. So more and more assets of importance are getting caught up because of the lack of runway to deal with them.
Thank you very much to our speakers, Michael Lynch, Shannon Kavanagh, and Sule Arnautovic.